What's up, everyone? Let's talk about Churchill Capital IV or CCIV. This is rather an old news, but I want to share with you the fireside chat video with Michael Klein of Churchill Capital. This was hosted by IPO Edge John Janaron on January 12, 2021. In the video, I believe Michael is giving tell signs of the Lucid rumor. Keywords mentioned in the interview include Tesla, EV, mobility. Mobility is the term Lucid described themselves on Twitter, and sovereign funds. In the video, Michael also details his past Spax and his plan for CCIV. So stick around, I think you might like what I have in store for you. Hi, my name is Anthony and welcome to Quantum Finance. I'm a former engineer and data analyst turned entrepreneur and investor. In this channel, I focus on high growth and disruptive technology stocks. If you're new, welcome. If you're returning, welcome back and thank you for your support. Please note that this video is for entertainment purpose only. I'm not licensed. Before I start this video, please help us grow this small channel to 5,000 subscribers by smashing the sub buttons below. Please like and share the video. Do comment below if you think the mergers between CCIV and Lucid Motors will happen and by when. With that out of the way, let's get right to it.
All right, we're just waiting for the meeting to populate. Thank you everyone for joining today. I'm John Janaron, the editor-in-chief of IPO Edge. We are having a special interview this afternoon with Michael Klein, who's standing by, who's the Chief Executive Officer of Churchill Capital Corp. And he will be with us in just a moment as the room fills up, and there it is, almost 5,000 people watching today. So we have a big crowd for Michael, who I will introduce in a second. Before I do that, I have to address an elephant in the room. I've received emails from no fewer than 50 or 60 of you asking about a specific news report from Bloomberg yesterday. I just spoke to Michael, and unfortunately, he is in a difficult position and cannot address that at all, but we have plenty of other good things to talk about. Michael has led no less than 5 SPACs, going back to 2018 with the first one, which is where we're going to kick it off. Then we're going to talk more about Skillsoft. We're going to talk about Clarivate, and we're going to talk about the big picture. So with that, Michael, if you don't mind, I'd like to allow you to introduce yourself quickly. For this audience, you probably need no introduction, but here you have Michael Klein, the CEO of Churchill Capital. Michael.
Well, listen, thank you very much. I appreciate you having me on this special session, and I appreciate all the folks that have tuned in to listen. It's a pleasure to be here. We've been incredibly fortunate in the business that we've built over the past 4 years, both our Churchill Capital and our Archimedes Advisor unit, which I'll discuss with you. And for those of you who I haven't worked with before or worked on investments with in any capacity, I have spent the past 37 years in this business, leading the investment banking and markets and banking businesses of Citigroup for a number of years, before starting our own firm, where we advise typically large companies, large investors, sovereign wealth funds on various different investments, acquisitions, complex issues. And we, in 2018, as John has described and no doubt will delve into, we formed the first general partnership solely targeted on using public equity vehicles or SPACs to build value for shareholders.
All right, great. Well, on that note, let's go back to 2018. So September 2018, you completed the original Churchill SPAC IPO. Over the last couple of years, I think you've helped build tremendous awareness for the structure and the product. So can you help us understand what's helped the market evolve? I mean, going back to the end of 2018, it was very, very different. I mean, I remember it well. And now SPACs are basically in the front page every day. So what's been behind this shift?
Well, thank you. I have to say, I've been around the SPAC business since SPAC was a 4-letter word. I guess it still is a 4-letter word, but it's not a curse any longer. My first engagement was actually not 2018, was 2004, 2005. We raised the first $1 billion SPACs for certain private equity players in that 2004, 2005 window. 2018 is when we made the decision to use our own capital as principals. And that came after we had both raised vehicles for other people. We had sold companies from Fortune 100 businesses to SPACs, and we we had a very good awareness of what was both the extraordinary benefits of the SPAC as a tool, but also what some of the limitations were. And quite frankly, we made the decision when we got into this business to effectively not only utilize all of the great benefits of the SPAC structure, but also make some fundamental changes, which we helped or believe we helped eliminate or certainly address some of the weaknesses. Now, I'm really pleased that we found the product early. I'm also thrilled to see the current acceptance that the product has. And I give credit really to people like Bill Gurley, who's a great investor. And in August of this year, he essentially said that SPACs were a legitimate path to the public markets. And he described his so-called door number 3, that this was the third path, and that it had a real value, and that he wasn't going to be surprised if he saw very high-profile companies, in fact, using the SPAC as a path to go public. And that was, by the way, probably one of the most important recognitions by an investor group. But look, I'll say to you that we've known for a long time that there are certain real benefits to using a SPAC. And in 2018, we knew that one of the benefits was for investors. Of course, you have a redemption feature, that's well known. But for investors, you have an opportunity to review a transaction before it goes public with just much more detail than you have with an IPO. Certainly retail investors who don't have access to IPOs, but institutional investors as well. The concept of a proxy document, which is 500 pages and forward-looking forecasts and 3 months of marketing, it's one of the really unique opportunities is for investors to have a better sense of what they really will be owning versus an IPO process that comes together in 2 weeks with a small prospectus and very, very fast meetings with only the most important institutions. Now, for companies, we also knew that it was a benefit because companies have the ability to negotiate directly with a SPAC partner and have the ability to not only set a value, but also use this mechanism of a merger proxy to put forward their story more clearly. But to be clear, we knew up front that there were also some real limitations. And when we started our business in 2018, we wanted to address those limitations incredibly directly. So the first was the issues that SPACs had, as I think most on this call know, and many of you are either investors with us or hopeful investors in situations that are being bandied about. You knew that one, the SPAC didn't have the commitment to close. It didn't have the capital that was guaranteed. Secondly, there was dilution from the founders' capital. And as a result, you had negative selections. And we made a decision, John, to eliminate those issues. And I can spend more time on it. And I want to make sure I address the issues that you want. But in 2018, what we did right up front was, one, we pulled together committed capital. So we made a decision that we were going to invest in every one of our transactions to make sure that any announced transaction was guaranteed to close and that we were ourselves direct equity investors. And in each situation where we've raised capital, we've put significant IPO investments in, and more than 50% of the public float is owned by a core group of investors that we have a very close relationship with, and in some cases are part of our partnership. That's typically 10 investors that control the vote. So we can guarantee the closing of a transaction, which we've done in basically every situation. The second thing we made the decision to do is that we would invest our capital at a higher price than the public markets. So we undid this fear of dilution by essentially being clear that we would only get our capital if the stock got to $15 in the Clarivate case in 2018, $12.50 in some of the other cases. We also have committed to hold for the long term, and we've committed to bring together value. And this, I think, is, for those of you who've been investors know this, we have 19 CEOs of Fortune 50 companies who are investors and partners with us. Those investors and partners include Alan Mulally, who was the turnaround icon at Ford and ran Boeing before that, and Andrew Liveris, who ran Dow DuPont and is now the chairman of private companies, Joe Iannello, who ran CBS, Johnny Ive from Apple, Jorma Ollila, who ran Nokia and then Shell, Bill Vecti, who ran Windows. It's a wonderful group of folks that invest with us and want to enter in to add value to a transaction. And the last piece is we brought together not just our capital, but all of our potential transactional partners. We have 25 people that are full-time in evaluating investments. We also have an investment from the largest consulting firm in the world in our business. We have a full committed operating structure. And 2018, when we put this together for Clarivate, it was our first test case. We decided that we would partner with Jerry Stead, who had been someone we'd worked with for 20 years. Jerry was our first partner in raising public vehicles. Before we even came up with the Archimedes advisors and full team, Jerry was the partner, and Jerry came in and worked with us to find a specific company in a specific industry that we could buy or at least invest in at an attractive price, at a structure that would drive value for our shareholders, and then we could help drive that value. And that's what Jerry's done. And I'll say for your background, you may or may not know that we have invested, we've raised $12 billion. We have $45 billion of public market cap value in the companies that we've helped create. If you were an investor in all of our IPOs, you've had a more than 100% annual IRR. We put more than $2.7 billion in the initial investments to work that are worth over $5 billion and change. And we're really pleased about that. So yeah, the market's changed a lot. So the number of SPACs out there that have been raised have proliferated. There's many challenging structural issues to that market, which we can address. We welcome all those parties. We welcome because it creates enthusiasm for great companies to be available. But because we've been reviewing situations for one vehicle or another since 2018, we have 4 years worth of, if you will, targets that we have been exclusively analyzing with our team and working to create public capital markets value. And that puts us in a position that we get to be incredibly selective. And we get to be incredibly selective because we have to put money in. We've put $1.5 billion of our partners' capital to work. We only take our equity when the stock goes up. We hold for more than 3 years, and we bring leading CEOs and operating partners either to be chairman, CEO, president, or lead the board of the company. So it's a different, we take a different structure than others for sure. We wanted to take away the initial dilution. We've done that with our higher price point than the investors. We wanted to take away uncertainty, and with our capital commitment from our partners and our own capital, we control the vote in almost every case. We've raised capital to eliminate any cash condition in each of our transactions. Skillsoft, which we'll cover in a bit, we were fortunate to have Prosus or Naspers, which is the Prosus group, put $500 million in, which essentially meant that all of the cash we needed to ensure closing was done. And that's critical for us. If you're working on a transaction with us and you're a great company, you need to be sure that not only are you negotiating terms, but you have certainty of closing. And everything that we put forward to the market, we will close, and then we will continue to drive value add, both from our operating teams, providing capital, and our full team. We've been leading equity capital markets businesses for the better part of 20 years, and that's part of our job.
All right, great. Well, I want to just touch on something you brought up there, Michael, as far as the immense amount of SPAC issuance we've seen. What do you think about the quality of the sponsors, the individuals behind these SPACs? Is that critical? I mean, is that a big part of what's driven the success of the SPAC market? And, you know, we've got over 200 SPACs out there hunting for targets. How much of the sponsors themselves, the individuals who founded those SPACs, how much do they matter?
Look, I don't want to comment on anyone else's vehicle individually. There's lots of folks that have raised these kinds of vehicles in the past year or so. They're creating a broader ecosystem. Certainly, they're creating an ecosystem for more transactions. I would say that the 2019, so just a year and change ago, when some of the IPOs that were so high profile, Uber and Lyft, and then potentially WeWork and others, when those were troubled, and when the equity capital markets professionals had a bit of a difficult time judging the last round venture valuations and ratchets and determining what the right trading price was. And it really was the first wave, I would say, where investors that were in the public domain, Fidelity and Wellington and T. Rowe, were also investors in the private round. So the IPO wasn't their first visibility of the company. That 2019 period was an eye-opener for some of the certainly venture capital firms and others who felt that there needed to be a better way, whether it was a direct listing or something else. And clearly, as Bill Gurley commented, the SPAC has become certainly one, if not the preferred way for that. Now, the partners that have raised capital, there's some wonderful executives, there's some very good investors, and then there's a lot of other people. And I think everyone on this call knows that one of the reasons that they can raise that capital is because there is an ecosystem of 50 or 60 hedge funds who have been created principally to invest in SPACs. And so that none of you are caught unawares, those hedge funds have the ability to leverage 6 or 7 times their capital from their prime brokerage only until the redemption date. It's very important to keep in mind that because of that, they can buy 7 or 8 times the amount of capital they have, but when the redemption date comes, they go back down to margin leverage. So it means they can't hold but 1 or 2 out of 8 that they own. That's a rented capital pool. That rented capital pool means that the vast majority of these 200 or so SPACs have really no certainty of capital. What they have is their reputation, their small at-risk capital, the work of their underwriter, and the hope that they find a very good transaction that they value in the correct way. That's the first. The second is because the market accepted a change in structure where underwriters were willing to take only 2% of their fees up front and put the rest of the 5.5% to the back, there's a lot of people that can afford to put in that sponsor, quote, risk money when it's only 2% of the capital raised. That also creates a different structural incentive because there's a huge deferred fee pool on Wall Street today. With circa 75 billion raised, there's $2.5 billion of fees that are waiting for transactions that close. So the SPAC issuance is probably, on the one hand, it's quite a good ecosystem that means more companies will look and use those tools. But by the same token, for investors, they have to be mindful that if they're not one of those core group of investors that are essentially controlling the vehicles, they have companies that may, or investment entities that may not have certainty of closing, may not necessarily have good deal flow because they haven't been in the business of looking for transactions. They may or may not have capital to help close or operating expertise to drive. Some are, and some won't. I certainly wish all of them successful. It's better for the whole system to be productive and add value.
Great. Let's talk about Skillsoft. I think that some of the folks on the call here want to hear more about that. So this is a merger that's underway. This is a really interesting sector. The learning market is shifting in a digital direction hugely. Tell us why this is something to be excited about and why investors should pay more attention to it.
Sure, I'm happy to. Look, Skillsoft is a company that we spent more than a year working on before we reached an agreement. And then when we reached the agreement, we only were prepared to go forward if the company met an extraordinarily high set of hurdles that they had to meet for it to be attractive to us. But most importantly, Skillsoft is the leading enterprise training company, the leading distance learning company in the world. It is a company that's been a leader in quote, ed tech, serving large and mid-cap companies for more than 30 years. It's got an embedded customer base, which with virtually all of the 1,000 largest companies in the world, that's 90+% subscription revenues. It's 90+% gross margins. It's huge cash generative. And because like a lot of companies in this world, they went through a massive leverage buyout, they were over levered, and thus they didn't have the flexibility to make the kind of investments that they should make in a massively growing ed tech market. So we agreed to put capital in only after the company agreed to deleverage itself. The company gave us full authority to bring in a fantastic new management team. The company allowed us to invest in acquisitions even before closing the transaction. And most importantly, they let us set this up at the most attractive valuation of any company that we've been part of arranging. 6 times cash flow, 10 times net income, which virtually no one is valued off of net income anymore. And while there's rumors of every venture capital investment in ed tech, whether it's Udacity or Coursera or Udemy being valued at 10, 11, 12 times forward revenues, we set this up at 2 times revenues. So it's massively inexpensive. It's by far the market leader. We have Prosus, who is the biggest beast with a $200 billion venture capital background as our partner. And we have the ability to make acquisitions to grow this from where it is today, 700 million revenues, 200 million cash flow. We expect it'll be $4 or $5 billion of revenues in the short time period under our near-term ownership. It's dramatically inexpensive. And I brought in a team of people that I've worked with for many, many years. We have Jeff Tarr running it as CEO, who was the president and COO of a company called IHS. And by the way, the leader of IHS is our partner in Clarivate. And Jerry Stead runs it independently now of us. And he built Clarivate into something that quadrupled value. Jeff Tarr was his protege. And Jeff, who also brought in the former CFO of IHS, Todd Hyatt, we brought in a whole management team to drive value. And we will. It's an extraordinary market. We make, and I should have mentioned this earlier, John, we believe certain companies are better public than private, better delevered than levered, better with a growth plan than a stabilization plan, better making acquisitions with inorganic growth. That's kind of a bit of our mantra for these businesses. And Skillsoft is in a market with distance learning, enterprise training that's growing double digits per year, and it's the market leader. And it's the only profitable cash generative one. It'll be delevered with the best management team, best partners, and we'll grow it organically and inorganically. It's really, and by the way, because our partners in investments include 2 very prominent technology venture families, as well as a number of long-term investors as our partners, we're going to hold this for a long time and be proud of holding it.
Great. Let's just shift back to Clarivate for a moment. Michael, so you guys were among the first to do a very, very big transaction with a SPAC, and you continued down that path. Is that where the future is for others as well? Because there are many, many deals out there that are far smaller. And if I'm not mistaken, I think to have the amount of market capitalization you have within, let's say, the Churchill family is way above anybody else. So why go big? And do you expect others to follow suit? Is that where the future is?
Look, it's a good question. I think it's important to come back and essentially remind ourselves that a SPAC is an IPO. I mean, it is simply an IPO. Now, it's an IPO that is being sponsored by an entity, but it has all of the characteristics of being public. So there will be IPOs that are bigger, and there will be IPOs that are smaller. There will be spin-offs that are the form of an IPO, where major corporations spin off an asset into a SPAC. So there'll be various sizes that take place. What we did on Clarivate, which was our first investment that we created ourselves, was the precursor to everything else we did. We made a determination. A number of our core partners had a view that they could make long-term investments in private equity, in venture capital, in index funds. But if you wanted to be actively involved in public growing companies, you had to be an activist, which they didn't want to be. And that group was working with us to determine how to put capital to work. Some great families, some big sovereign wealth funds, some great investors. The second thing we found, just as I get older in business, is most of our clients for 30 plus years, the CEOs that are great, they finish their term as a first-time CEO, or they get merged out, or they make a decision for a change in life. But with age the way it is today, these folks, after 10 or 15 years as a CEO, Andrew Liveris, who ran Dow, or Alan Mulally after his second gig at Ford, they still have a tremendous amount of energy. They want to be in the public markets. They want to be part of growth. They don't want to be part of leveraged private entities, and they want to have equity. Now, what we've offered them, and we started with Jerry Stead as our core partner, and Jerry is running Clarivate independently. It's its own company. I've stepped off the board to focus on all the Churchill matters. But the idea was very simple. We raised the capital. Jerry operates the full of the business. He runs a business plan that his business plan, his strategy, a public company model, not a private model. So Clarivate, like others that we've looked at, not all, we're looking at venture situations, we're looking at very high growth companies, but one group that we've looked at of scale, which we have a demonstrable advantage, is we have the ability to invest in companies that when they're levered, they pay down $1 of debt to create $1 of equity value. And that's what Clarivate was planning to do. But if you take them to the public market and you change the model where $1 of cash flow growth can be valued at a 25 times multiple, you want to focus on growth. And that's what Jerry did. And Jerry did a phenomenal job. He put in place his own strategy. He brought in a full team. He got the full backing of the prior owner who rolled all their capital in. And he got to work immediately as not just the chairman, but CEO. And he's done an unbelievable job to create value for everyone. Now, that was a $3 billion equity valuation that's now worth 7 or 8 times that as it's grown. We'll continue to look at things of scale with one of our vehicles, Churchill 4. We have $2 billion of capital. We'll look for something that is a very, very extraordinary opportunity to use that scale of capital. It's a differentiated advantage. When there's vehicles worth $200 million, they're competing for the same product. When we have different size vehicles, we use them in different ways. And having larger vehicles means we can do much larger transactions. And we've had the good fortune that folks have trusted us to look at companies as valuable as $30+ billion. But we're only looking for investments, A, that we want to commit real capital to, B, we're committed to the long term, C, one or more of our operating partners can add value, and D, we can buy or invest in it at a structural, meaningful discount. Skillsoft is a 65% discount to its comparables, and none of its comparables are profitable, as an example.
That's great. I want to get more into some forward-looking stuff with the current vehicles that are out there right now. But before we do, I know some folks want to hear about Multiplan. We've got some Multiplan investors on the call today. Can you tell us why the opportunity looks so exciting? Looking back, did everything go as you would have liked? And why are some market participants not getting it? Because it hasn't traded as well as some of the others have.
Yeah, no, for sure. Look, Multiplan is a truly extraordinary company. Multiplan has a unique, it can't be even competed with directly, and it certainly isn't replicable in its current form. The business has a unique network and data structure and technology that allows them to save $20 billion a year for the healthcare industry. They save that after healthcare is delivered by healthcare providers. So they don't reduce any healthcare that's given. They don't make any healthcare decisions. They don't have any healthcare liability, nothing. But they process transactions in the healthcare space on a long-term contractual basis that uses their unique technology to reduce the bill by 20%. So that's $20 billion of savings for healthcare payers. That's insurance companies. That's you and me, as with our copay. It's massive savings, and it only occurs because they have the analytic technology to analyze every bill and reduce the cost of healthcare. They've done that for 30 years, and it grows consistently every year. Both their clients grow, their clients' volumes grow, their savings grow, and they only get paid a percentage of savings. The net result is the company has a business that has grown from $300 million to nearly $1 billion in revenues in the past decade. It's grown from a 40% margin to an 80% margin. It's got massive cash flow. It's the leader in the business. We made the investment after 4 different long-term sets of private investors had invested and made money at each step along the way. I had the good fortune of looking at the business in 2013 for another buyer, a very well-respected buyer who wanted to buy the business quite badly and couldn't come to terms. So we've watched the business for the better part of 8 years, and it has met or exceeded everything that it said it would do. Now, the other thing we were able to do with Multiplan, which we were incredibly pleased about, was this company was levered about 7 times cash flow for almost 20 years. By deleveraging it, we could begin for the first time to invest not just in organic growth. Unfortunately, healthcare costs in this country go up 7, 8, 9% every year. So they have an underlying tailwind, which is obviously beneficial to the business, but to invest in organic growth. And by deleveraging the business, they are rapidly investing in organic growth, which you will all see as the company reports and comes out of COVID. Second thing, they'll be able to make acquisitions. They couldn't before. They were too levered. They've made their first announcement just about a month ago. There's more on the way. Third, as a business, they're throwing off now between 8 and 10% free cash flow yield. So it's ridiculously inexpensive. But we announced the transaction and we made a couple of errors. We did things, I think, extremely well in that we did immense diligence. We talked to their core customers in depth. We got commitments from their customers to do business with them. We got commitments from management. We have a great view of where the business is going. But one of the things you learn with the SPAC market is you have to be able to make the company go from private to public seamlessly and quickly. Because we did a massive refinancing right as we came out of the business, all of our underwriters who were part of the transaction were part of the refinancing. So we were left without any research coverage for the better part of months. And we were left alone, having just told a new story about a new company. And that made us vulnerable to short sellers who have an interest in creating stories that are untrue. And a short seller came in just before our third quarter earnings beat, just before we announced an acquisition, just before we started to get research. And they threw some, I would say, specious comments to the market. And what you'll see from the company as they report earnings in Q4 and thereafter is those specious arguments will be incredibly clear. The main argument that this investor made, which was a sort of a trying to respond to the ultimate quote negative, which was your main customer is going to leave your business in the next year and leave you near bankruptcy. Well, our main customer is growing faster than any other customer. There's a great partnership. The company serves that customer extremely well. You'll see that in our numbers. You'll see that going forward. The company will be, and we're a massive investor. We don't have any shares in our pockets until the stock gets over $12.50. So we're long-term committed above price investors, but it's a terrific company. There is no other company in the world that can do what it does for healthcare savings. No one has the technology that allows 98% of their business to never touch human hands. No one has this cash flow. And I think we'll see really extraordinary value enhancement come from Multiplan.
That's great. Michael, I want to ask a big picture question if I can. So going back to 2018, the first Churchill SPAC, you didn't see as much action in these pre-revenue companies. These days, electric vehicles, space exploration, that sort of stuff is all the rage. How do you feel about that when you're looking at a company that might make a whole lot of revenue 2 years from now, but is still just ramping up? Is that the sort of target that you guys are interested in? Or, from what you've been describing to me, you're very careful about, these working financially. What's your view on both that shift happening in general in the SPAC market and whether or not you guys are interested in owning something like that?
Sure. Listen, we're looking at companies throughout the entire life cycle, from very early in their development to very later in their process of being leveraged buyouts and needing deleveraging to grow. We had the benefit of being able to, on Skillsoft, use a debt restructuring to eliminate $1.5 billion of debt before we even touched the asset. We drove that for our own benefit, and the company partnered with us in doing that. But we look at the whole life cycle of companies, and what we stick to fundamentally is, one, companies that should be public will take public. You can't bring a quote company that should always be private in the public. It has to have tailwinds in the industry sector. It has to be a growing company organically and or have the ability to grow inorganically. We have to have great trust in the management and leadership. We have to have operating partners. And we have many operating partners that have great knowledge of those areas of great growth today in mobility, as well as in other areas. We have within our camps 11 technology executives, ranging from Sam Altman, who ran Y Combinator, and Imran Khan, the chief strategist of Snap, to Bill Vecti, who ran Windows, and Alan Mullally, who's a phenomenal engineer and turned around Ford. So we're looking at all kinds of high growth companies. We need to have conviction because it's our capital, because we have a higher hurdle rate, because we hold it long enough. And what we've told our investors in our recent capital raises is we don't want to invest unless it has at least enough growth to be called, quote, GARP, growth at a reasonable price, as a message. And in addition, we won't go beyond, from a growth perspective, those companies that we don't believe the technology has been proven yet. From our perspective, it's not our job to take a technology-proof bet. That's not what we think is appropriate for the public markets. And I do think some of the SPACs that are out there who will be taking a bet that is much more binary on technology, that's an area of risk that investors, I think, are not expecting, because venture capital, as you know, has a portfolio. If you have 20 investments, 3 of them may be home runs and 10 of them may be really bad and 7 may be okay. But that portfolio math means there's whole sectors in mobility in particular where many of the companies just will not have the technology to be the replacement in short distance travel or air travel or go through it. But there will be winners, and there will be very big winners. And if we believe in the company, if it's proven out its technology, if we believe in the management, if we believe that we can set it up in an appropriate value for investors, if we believe we have operating partners that can drive value, and if we believe in the company, we'll make that investment.
That makes a lot of sense. Can we just look back? I'm trying to map this out. Do you think it was a couple of marquee SPAC deals that caused this shift towards these very high growth, often pre-revenue companies? I'm thinking Virgin Galactic, perhaps. And will that persist, or do you think that there's likely to be a shift back towards stuff that doesn't look so much like public venture capital?
Yeah, well, that's a great question, and I would say first and foremost for everyone that's involved in ICR, who's a really wonderful investment relations firm, anything that you see us do, we will have massive conviction in the growth and the value upside. And we don't differentiate, if you will, between something that was owned by venture capital or private equity or owned by a family or owned by a company. Because we have these 20 CEOs that are so well respected, we have a lot greater credibility when we make an approach, which we do generally exclusively, because we can commit to close the transaction, because more than 50% of the quote SPAC is owned by a small group of people that we're directly engaged in. And because we have large capital behind us, we can commit to close. So we get, I think, our choice. We don't get a negative selection. We get to choose the companies. In each situation, we've closed 4 acquisitions. Each of them were exclusively sourced by us because of a specific relationship that we have. Now, as these processes go forward with all of the SPAC activity, by the time you get near closing, the banks that are involved will try to negotiate and or do a market check. But we've been very fortunate that we have great relationships with both CEOs and sovereign wealth funds and private equity and families to create those. To your question directly, in the early 2000s, most public equity firms were anxious because LBO firms were buying companies right and left and then taking them public. And the only way for them to buy those LBOs were at the IPO phase. So if you were at Fidelity or at T. Rowe or at Wellington, you were frustrated that the juice, if you will, was squeezed before you got to buy that. So the first wave was all about recreating access to private equity. And you saw LBO firms, players making their way into raising capital. through a SPAC market, and it was really modestly successful, and many weren't successful because unless a company is a growing company that should be public, it's not the right tool. It's not an IPO. It doesn't create the value. And that was learned, I think, in that phase of the market, that private equity transactions and private equity vehicles, there's other ways to play that, both through buying investments in Blackstone or Apollo or KKR. There's other ways to play that, but not through that tool. So the shift has been towards growing companies. And the only question, John, has been how fast growing and how early stage and how much risk you're prepared to take. And with the detail of the proxy and the longer term private diligence and the longer term marketing, you get a lot better information, regardless of whether the company is really early stage or a little bit later stage. But the risk that's being taken by some before a technology is proven is a very different risk. But the transactions that probably drove the market, again, just my opinion, I think Clarivate was one of the early ones in 2018 that by racing up to near $30 and showing that you could convert companies to a more rapidly growing phase was very helpful. DraftKings clearly was a very important transaction for the market because it not only showed great value creation and was well handled, but also opened a much broader door for retail investors. And Virgin Galactic, where we represented Richard Branson on the merger of that to Chamath's vehicle, that was very successful. It's hard for people to remember, but it actually wasn't successful at closing. There was, I believe, of the 700 million, only 300 million stayed in, and then 100 million was added by Chamath. So it was a struggle, and in fact, right after the closing, it dropped. So it was a tough play at the time. But there's a bunch of things that changed for that. One was, of course, the explosion of some of the retail investors. Secondly, there was a really seminal report by Morgan Stanley sometime in the early part of COVID that essentially said, look, we can't predict where the economy is going to go this year or next year. But if you've got an investment in a company like Virgin Galactic that's going to show value in 2024 and 2025 and isn't impacted by COVID, that's a safer place, which is a perverse thought, but a safer place to put your capital. That really was a bellwether comment by the Morgan Stanley analyst, and I think it drove a lot of people there. And then other transactions have gone on the back of it. And I think there's certainly companies where some of the SPACs are essentially doing what I think we saw in 2000, which is look for a company that has a high valuation, and then make a decision that I'll buy a smaller version and make it designed to grow as fast as the big one that has the high valuation. And clearly you've seen that with Tesla and a bunch of the EV companies that are not as well created as the best of breed private ones.
That's a great point. I think that narrative does explain what we saw with that recognition that maybe it could be safe to bet on 2024 instead of 2021. But do you have any advice for retail investors? I mean, I think that we have certainly a few who are watching who've seen SPACs really take off, and there have been a lot of big winners. But do you have any advice for them? And can I also ask how you in the business think about the retail investors who might take interest in these deals once you announce them? How do you look at them versus institutions who are traditionally the ones who are probably getting most of the company's attention?
Yeah, look, I think because we are retail investors in the sense that we're putting significant capital up, not just in the founder shares, but in the IPO itself. And by the way, when our stocks trade down, we buy them in the public market, as we did with Multiplan, where we announced an individual, my firm, buying program to buy in the market. We're right alongside in that way, and because our deferred structure, which means we don't get our shares until it gets to 1250, means we're behind retail. So we have a very similar, very active rooting interest in the same way. And I can't give advice to retail investors on how to do their diligence and how to make decisions. I can give only a couple of pieces of guidance, which is pre-closing or pre-announcement for any of the vehicles. Obviously, making sure that those participants have a proven track record of being able to source transactions, a proven transaction background of financing transactions, because The pipe is generally a crutch that retail doesn't see. The pipe is something where if a company allows a SPAC to go to market with the so-called pipe, they're taking their risk, if you will, of a quasi-IPO process quietly that retail doesn't see. So the ones of the pipes that have failed, retail hasn't seen. But when the transaction pipe is successful and great investors, Fidelity, T. Rowe, Wellington, buy in the pipe, it's meant to credentialize the base IPO. But bear in mind, those investors have then bought in the pipe. They haven't had to buy in the IPO. So you need to make sure that the SPACs that you work with have capital behind them, have a proven ability to source transactions, a proven ability to close transactions, and they stick around to drive value. And if the value is not achieving what is hoped for, they stick around and get even more active. So that's the advice I think I would give for transactions from launching of the SPAC through till the announcement. From the announcement onward, really what you'll find, I think, is the best SPACs will find, and the people that are behind them will find the way to make sure that the holders of their company are the right long-term holders. What we do the minute we announce a transaction is we go directly and immediately to the shareholders that should own the company and go to them first, because unlike an IPO, you have a set of orders, and Goldman or Morgan or Citi or others allocates them on a day, and as good as they can be on that one day, they're taking a point of view of their best relationships and the valuation as good as they can be. With a SPAC, if you want to buy the shares, you have to buy it in the market. So the best thing to do is to go as quickly as you can to investors that should want to own it for the long term, so they can do their work up front and buy the shares and build their valuation at an early stage. What we've been doing, of course, with Skillsoft from announcement, with Clarivate, we did that from announcement at $10 and built it up from there. We're doing that, of course, with Multiplan. So there is that aspect. Now, so if I'm a retail investor, I know that I haven't seen the pipe, so I have to count on those transactors that are going to see first-class companies, going to be able to close them, and going to be able to build value. And I do think, to your point earlier, there will be a point in time where windows close, and in particular, because of the leverage in many of the investors, not all, but many of the large investors behind the SPACs, when the windows get bumpy, the markets close down. And the result will be, just as we saw in 2009 and 10, half of the SPACs that were raised gave their money back. They actually didn't find a transaction. The investors that bought them were arbitrageurs holding for interest rates. And as much as you were excited about the possibility of the warrants and the growth, they gave the money back because they couldn't find something. So we'll find, I think, in the next year or so, a number of these vehicles will have a very hard time finding transactions. There will be a shrinkage again, hopefully to those that I think add value to investors, and those that have been repeat issuers, and those that have real money on an ongoing basis at risk.
That's a really interesting point. Michael, can I ask you about a term that we brought up in an earlier session today, which is one of these new terms that's come out from the SPAC world. So a SPAC off. So you've got a very attractive target, and they have plenty of SPACs they might want to talk to. In the world where you operate, which could be companies worth 10 billion or more, is it the same dynamic as there is in the area where most SPACs might be hunting, more around $1 billion? Is it less crowded, more crowded? How does it feel? Because you are, without exception, going for bigger targets.
So look, it's thanks for the question. It's typically a different set of targets, and it's a typically different set of competitors. We start, and this, I can't overestimate this. We start with an inventory of potential targets that are about 800 long, that we have built relationships with and valuations for over the past several years. And given some of our partners, Oak Hill Advisors is a $50 billion leverage finance firm. They have investments in a very long list of the private equity portfolios. So we learn about the companies before we approach them, so that we're starting a process rather than waiting for an investment bank to call 20 SPACs to just compete with each other. We have deep tentacles into the venture community, both because of our large investors from Emerson Collective and our 11 technology partners and our new partnership with Prosus. So we have the ability to review these companies, hopefully, and now there's lots of company, obviously, as we see from the past 9 months of capital raise, but we approach these before they've brought a bank, before they've done anything. Now, for us, we're looking to the places where we can add the most value. So the scale of our capital means we can do something bigger. You've got a $1 billion vehicle, as we've had, and a $2 billion vehicle. You want to make that a minority of the value of what you're investing. You want the existing holders to roll over and be your partner, because that's the best way to negotiate the best value. They're not taking much off the table. They're giving you the best value. So we want to substantially extend the capital that we have by doing things far larger than the capital that we've raised. It's also far less dilutive. So not only do we defer our value till the stock goes up, but by making something that in Multiplan, it was an $11 billion transaction with an $11 billion vehicle. So it was de minimis. Some of the new structures that have been put forward, even on the largest, where you have a 6% warrant on the whole company you buy, means that if you do a $20 billion transaction, you get 6% of the whole $20 billion. We would never do something like that. It's just too much dilution. But we're looking at larger things because it is less competitive, and because the CEOs that we have, and our list is generally pretty public, are used to running much larger businesses and can add value. And frankly, in many cases, the larger scale companies have a lower risk profile because of the access to capital markets and the companies. And they're certainly less competitive. You're competing against strategic buyers if there are those. And of course, if there's a big strategic buyer and the target is minded to sell to another company, you don't have the ability to be the winner. Some of the companies are being chased by very large private equity firms. And if it's meant to go through leverage in a private fashion, we wouldn't want to be the winner anyway. So we do see that. Now, recently, because of some of the new partners that we brought in as operating partners, we have a really fantastic pipeline of earlier stage companies that have proven their technology. They're not as large as the sort of $20 billion transactions that we've seen in other ways, but they have very large opportunities and capital needs.
Great. I want to go back to pipes for a minute. Over the last year, the percentage of companies that required a pipe to get a merger done, increased. I'm not sure exactly how high it is, but someone in an earlier panel today mentioned that these pipe investors look a lot like institutional IPO investors. So if Fidelity or Wellington might buy into a pipe instead of buying into an IPO. What's your thought on how important pipes are and whether or not demand from pipe investors is going to continue to carry the market?
Yeah, that's a good question. So we raised, I think, the largest pipe that's been raised, a $2.6 billion pipe, privately, confidentially. We've raised pipes for two other transactions for us, and they've been useful for sure. I think the pipe has become a bit of a, what I would say, a bit of a cookie cutter tool. So as the number of companies that have been created as Spax proliferate, the number of banks that get involved, and I saw this when I started in 1987, if you can believe it, because I'm older, the first or second business working with financial sponsors. Back then, they weren't even really called fully LBO firms, and they weren't called private equity, but it was, you really had KKR and one or two others. And when we first started that particular group, it was unusual. And by the 1990s, every investment bank had a group that viewed them as core customers. And that's what's happening with Spax. And M&A professionals are getting involved in understanding them. And what happens is then you start to get what are called more standard processes. And there's two standard processes. One standard process is the so-called SPAC auction, where a bank will decide that I'm going to convince a company to because they lose economics if they're not taking an IPO path, which is very lucrative for them. They're going to go down the SPAC path. So what they do is they have a quasi auction. They'll call 20 different SPACs that look generally alike, and they'll give them chances to do due diligence. And 5 or 6 of them will come in and give a valuation. And then there'll be negotiation typically on how much economics they'll give up. There's much less negotiation, frankly, on certainty. And that's the key. That's the absolute key for getting things done. It's why the SPAC is a better tool than an IPO for a lot of people is certainty. But that process has become one part of the process. The second is the pipe, where essentially there's a view, and it's generally, there's a piece of it that's good. If you have a $500 million vehicle and you need $1 billion of capital to fund a company, if the 500 is raised in a pipe, it doesn't have the same promoted dilution. So companies would rather have more come from the pipe. It's understandable in that regard. However, there's two aspects of that that are important for certainly companies to understand. And we spent a lot of time with companies just like Virgin when we worked on their side in the Chamath transaction, which is the pipe is essentially a private test run for an IPO. So if you're a company that doesn't have a commitment and you let one of the sponsors go and do an IPO test and it fails, then you failed on your IPO. And if it succeeds and you get the biggest investors that are institutional names to come in, you really want to make sure that they're only coming in with a part of their investment, and the rest of their investment they'll buy in the public market. Because allowing those investors to just come in at $10 when everyone else is hopefully buying in at 12 or 14 or 16 or 18 is actually not the best tool for SPACs. It has become de rigueur because it's their way of getting to certainty. We took a different view. We made the decision that our base vehicle should have certainty, that our base vehicle should be funded and we give 10%, 10 investors own 55%. Typically, 2 of them are on our board. The next 10 investors get us to 80%. So with 20 calls, we can have certainty. In the Multiplan transaction, as an example, we had a full commitment for the full IPO as part of the transaction. With Skillsoft, with Prosus now committing 500, that's a main shareholder that's committing to fund the entire cash condition. So the pipe is a crutch on the one hand to make sure you have cash. On the other hand, to pre-market and market test for the SPAC and for the underwriters. It has good benefit, but it does take away some of your best buyers from the market. And if you can find certainty without it, that's better.
All right, great. We really appreciate everyone who stayed on. There are several thousand of you actually, so this has been terrific. But Michael, can we leave these folks with one last thing? Any predictions for the SPAC market in 2021? And can you give us any thought on any sectors that you think make more sense than others this year? I mean, there's been so much action in technology and these, companies that are pre-revenue and so on. Does that continue? How do you feel about that industry in general and any other surprises that you see on the horizon?
Listen, let me thank you. This has been, if it's been a long call for me, it's been a longer call for everybody who's listening. So thank everyone who stayed online for hearing this. We do believe that what we have created by having 19 CEOs that have managed trillions of dollars of market capitalization, by having core investors and great long-term credit partners, whether it's Oak Hill or Magnetar and the family offices, by having a leading consulting firm as an investor, by having an investment committee led by a partner from Andreessen Horowitz, all the way through to partners from Clayton Dubilier and partners from other firms, by having we have 60 to 80 of our own people review every transaction. We're not 2 people sitting around in a garage. That's embedded with consulting diligence as well as real diligence. And we take the view that we want to have every bit of information because our LPs are investors. Our LPs are the big funds. Our LPs are not the state of California or CalPERS or state of Oregon, which is what a private equity is. Our LPs watch the market every single day like we do, and we have to review investments like that. So having committed capital, having a massive commitment to diligence of quality, bringing in change agent CEOs to drive value, committing to have our capital only come in behind investors at a higher price and hold it for longer, we think that's a model that will allow us to be a sustainable participant in this market for many, many years to come. And we have a very clear point of view. We're not a big fund, and we have to do 20 deals per year. Every specific vehicle that we have to find a company that we decide and determine is great, that we determine meets our valuation, our growth considerations, all of our standards. We want best transparency, best working relationships with their vendors, partners, and employees, but we want to create enormous value. And unless we have the ability to set the value up right and then drive value, we won't do the transaction. Look, we looked at 200 companies since the pandemic started, more than 100 non-disclosure agreements. 90, I think, of those were exclusive. We still have 50 projects that are in the pipeline of our teams today, the vast majority of which other people aren't looking at. It's just us. So we have the ability to be highly selective, and we made a real choice on Skillsoft to do something that others weren't going to do. We told the company in March of this past year that we would only buy the company if they went through a debt restructuring before they gave the keys to us, if they eliminated their private equity sponsor, if they completed not just audits, but rolled out a new technology. And if they would do all of that, we would invest at 6 times cash flow and 10 times earnings. So we do that hard work because that's what we can do to create value. And we spent over a year, tremendous amount of time and money and effort from lawyers, consultants in our team. And they might not have achieved the goals that we set for them, in which case we wouldn't have gone forward with the transaction, but they did. And it's going to be a massively successful transaction. So we see in 2021, the business models breaking down into 2 kinds. One kind is what I think is value added, and I think we're in that. We believe that we're creating value with our capital, with our operating partners as either mentors or driving value, with our ability to stay with the company and drive investor knowledge and continue to build. We've helped Clarivate with acquisitions every step along the way, as an example. It's a separate company run by Jerry Stead. It's his business. It's separate from Churchill. I'm not on the board, but we help them because we're big investors and we remain big investors. So those value add players, and there's certainly people in the market who've done interesting things where they add value based upon either their skill set or their network or something that they bring to the party. It's the extraordinary minority of the players. I don't believe that celebrities and politicians are great things, but I don't believe that drives the value add from a Spax side. The second that I think will do well is there are people that are in the technology world that will have the ability to do very little for the company, but just simply give their vehicle to the company in exchange for the company going public. And for that, they'll give up pieces of their economics. They won't need to stay on the board. They won't have governance. They'll let people have AB shares. They'll do all the things, but they'll use the fact that they created the vehicle and paid for the underwriting to let someone go public through that way. And some of those will work out, and some have worked out, by the way. But those 2 sections will be, I think, a number of companies per year. The middle, those SPACs that don't have that unique access and don't have value add, will, I think, have a much more negative selection bias. And look, we're in a great market. COVID was devastating. The unemployment is devastating. The political challenges were difficult, but we have a phenomenal equity market and most things are working. But a year from now, as you asked me for 2021, a lot of those that are not adding value, as I think we are, and not just having a really good network to hope to have one transaction to attach that's a great company, those folks have a difficult time. In terms of industry spaces, I think when we sold a business out of Dow Chemical to a SPAC in 2012, it was almost unheard of that a Fortune 50 company would sell a division to a SPAC. And it was almost unbelievable in that sense. And I think right now what you're seeing is each of the different transaction, if you will, sources, public companies with divisions, venture-backed companies, private equity, family-owned businesses, each of them are looking and saying, do I go public regular way? Do I go public through a SPAC? Do I raise private capital or do I sell? And some of them are being confused, in fairness, because they think that the SPAC is something more magical than an IPO, and they don't really realize yet that the investors really have to stay there beyond the redemption. And so they don't quite know that. And then in the industry spaces, I think you just have to look at economic activity levels and relative valuations. I learned a long time ago that for something to just be cheap, it has to be extraordinarily cheap, which means, 10 times earnings, like we did with Skillsoft. That's just dirt cheap. That you just don't ever have a situation like that for a quality company that's growing. But leaving aside cheap, the only companies that are going to work are going to have unique organic growth that comes from their industry, comes from their unique market position, comes from technology that they've proven and that they've already got scale, or you can see the scale coming in front of them, that have the ability to drive earnings over time, that it yields real cash flow. And also the second group are going to be those that are in fragmented industries where you can see great consolidation. And that consolidation, which is a different piece of the puzzle, Skillsoft will likely buy a dozen companies in the coming couple of years. That is a massively fragmented industry where we're the biggest with 700 million. Nobody's bigger than half our size. So there'll be lots of consolidation. So that's organic growth plus inorganic growth. But areas that you'll see more activity in Spax, because most people won't take on the scale and size that we're looking at. Most won't take on the challenge of sort of negotiating as hard as we did to get it so cheaply at Skillsoft. Most won't stick with companies to work with them to find acquisitions and add on. What you'll see more of in the Spax side is growth companies. You'll see, and the question will be for everyone is how much growth is appropriate to be attractive, and how proven is the company at that moment in time. And there's lots of great technologies. I don't want to belabor the question, but all of us sat through, our whole team, when we worked remotely starting in March, and we wanted to understand which industries were fundamentally changing. So retail, hard bricks and mortar versus online, food, restaurants versus delivery. Which ones had fundamental changes, Zoom versus business travel, and which ones were just bumps for a period of time. They were bumps during COVID. And you see that some companies that needed to be more physical had bumps, but their model hasn't changed. So we're clearly looking and seeing that you will see a lot of high growth companies. Some of them will come forward that without proven technologies, and that'll be a portfolio game. There'll be in certain sectors, battery technology as an example. Some of the other software related businesses, a couple will work, a bunch won't work. You'll have to have a portfolio approach. Well, secondly, we're going to see, I think, some larger scale, higher growth companies that have been in families and private equity companies for a long time that'll come public, because this is a great tool for them. I think you'll see the industries widen from some of the newer industries that are very exciting and that we're actively engaged with our operating partners, but you'll see fintech widen to go beyond insurtech, beyond neobanks, beyond the payment space. You'll see a tremendous amount. We're seeing a tremendous amount in healthcare. Health tech, you'll see a significant more that comes from that. There'll be an entire a new wave of activity in the ESG space, and in particular post the change in administration and some of the infrastructure going to the Green New Deal, a tremendous amount that will be in some form of ESG, in particular renewables from an energy perspective. You'll see a tremendous amount of activity. You'll see a fair bit of I think, cross-border activity. Our belief, and we'll soon have something to show for it, that this wave will be in Europe, and it'll be in Europe at a scale that's really quite large. That tends to have been sort of an investment trend over the years. Activism was very large here for a decade or 2 decades before London, and then Europe started to see vehicles come in that. I think you'll see a lot going into European companies in that regard. So anyway, I hope that's helpful. I will say only in closing, we're deeply appreciative of everyone's interest in vehicles that are SPACs and their participation and their sponsorship. And from our perspective, we don't do what some of our other folks do. We don't get up at CNBC every day and bang on our stocks. We don't make those kind of announcements. It works for other people. It hasn't been our model, at least for recent. We let We let the companies that we invest in and the operating partners that we have really lead the way. Secondly, we are committed to create value with every single investment that we put forward. There is no investment. We're not looking at a portfolio. Every investment, because we don't make even our money back until the stock goes up meaningfully. So you'll see that continuous commitment from our side. And you'll see us continue to reinvest our capital back into each of these companies. And you'll see us continue to add operating partners that allow us to operate in the way we do, which is rather than be generalists, we're multi-specialists. We have teams attached to Alan Mullally that crosses his specters, and Andrew Liveris and everyone. So I hope you'll see us continue to do transactions that are successful. We're pleased that if everyone was an investor in all of our vehicles from the beginning, which is just a couple of years ago, you'd made at least 100% return on your capital, and we're pleased about that. We hope to continue to drive those kind of returns. And certainly, if you don't get those returns, we won't. And we believe that the market will shake out a bit in the middle for those that don't have unique sourcing and don't have value add. We believe that some of the quote promotional activity will attract attention. Some of those attention will be lawsuits and regulators. But we do believe that the SPAC tool is a tool that companies and investors can use as a very important piece of the capital markets. 2020 probably was the year that was confirmed. 2021 will be the year that everyone asks the question, can it continue or was it a bubble? I think you'll find that it will continue for many, but not for all of the participants.
Great. Michael, well, we can't thank you enough. As you just mentioned, you don't do a whole lot of media, so thank you for that extended and wide-ranging fireside chat. Also like to thank ICR for having me be part of this conference, and of course, everyone who listened in. So thank you very much, and we hope you enjoy the rest of the conference. Thank you, Michael.
Thank you, everyone. Thanks for taking part.
So there you have it. If you find the content of this video valuable, please smash the sub button if you have not already done so. While you're at it, smash the like button as well, and do share the video content. Also comment if you think Lucid and CCIV merger will happen and when. I'll see you down there. Thank you for your support, and let's go make some money.